So the next discussion is going to be on the advantages of investing in digital assets within a regulated environment. That's going to be chaired by the moderator, David Reed, Director Capital Markets, Digital Assets and ESG at Invesco, and he's going to announce the panel. I hope you enjoy the session.
Okay, good morning, everyone. I'm going to take the remarks from the previous session as a challenge. We're here to talk to you about regulation for the first panel session this morning, and I'd be very disappointed if we didn't get even more enthusiastic questions at the end of this session. So we'll see how we go. Delighted to be joined by by colleagues on the panel this morning. I think pretty much most jurisdictions and areas of the globe are represented here, so we should be able to kind of put a global perspective on the questioning and so on. Sorry, didn't introduce myself. David Reed at Invesco. I coordinate our digital asset activity and based here in the UK, but pretty much with a global remit. So looking across, our activity in most parts of the world. What I'll do now is just go through the panel, and they can introduce themselves, talk about what they do within their companies, and a little bit about where they're based in the world. So if we start with Max.
Yeah, thank you, David. Max Heinzle, founder and CEO of 21X. We are a Frankfurt-based fintech in the process of transforming into a financial institution a couple of weeks from today, operating under the EU DLT regime, the first ESMA licensed trading and settlement system. So pleasure to be here. Thank you for having us.
Hello, everybody. I'm David Packham. I'm the co-founder and CEO of Chintai. We are a Singapore-headquartered company in the digital asset space. We hold dual licenses in Singapore that give us license to issue security tokens, deploy secondary exchange markets, and also additionally custody. And ultimately, we have built out a series of solutions for the industry that enable the full breadth of the trade lifecycle to be deployed on chain, automation of compliance, and a variety of other services as well.
Good morning. My name is Cynthia Bessette, and I am the head of the Digital Asset Management Division at Fidelity, or FMR, in the United States. Within asset management, we actually manage several $trillion in assets for our clients across our platforms, both retail as well as institutional. And the digital asset management business sits within asset management. We're responsible for building out investment products, both from the standpoint of looking at crypto as an investable asset class, but also focused on the future of finance and the integration of digital assets into traditional financial portfolios and solutions. And this is where tokenization is a big part of our prioritization and evaluating asset classes, as well as opportunities for efficiency in moving assets on chain for our client solutions.
Thank you. My name is Thomas. I'm the founder and CEO of Assetera. Assetera was established 4 years ago and is a fully EU-regulated capital market for investing and trading blockchain-based securities. We offer our service for retail and professional clients, and current tokens listed on the platform are representing shares, bonds, fund units, and others like revenue participation. And as we speak, we are adding new tokens on the platform with our existing partners and with our new partner, CHEX, which we signed last week. Very exciting about that one. And together we want to solve the distribution of certain securities to the mass market. Quickly on our system, we have built our system in-house. It features a DLT system deployed on Polygon chain for transaction and settlement. Thank you.
Thank you all. I think we're going to just start with a bit of a level set this morning, and just there's lots of discussion around the difference in regulation around the globe and the impact it has on adoption and so on. So be interested in each of your views on, where are we currently with the incorporation or the support for digital assets within a regulatory framework. So start with you, Thomas, if I can.
We see a different speed, different stages, a different interpretation of the regulatory framework. What we heard yesterday is the clarity, the sustainability of everything starts with the regulation, certainly. We have on different speeds. We see in Europe, with the Bank of England, with the sandbox, with the EU, with the DLT pilot regimes, a lot of happening in addition to already existing regimes like the MiFID regime and the upcoming MiCA. On the other hand, I have a bit of a struggle when it comes to what we see in the Middle East. You have digital assets and digital securities in one regime, which is not the case in Europe. So we also have to see region by region, jurisdiction by jurisdiction, what's actually inside. And yeah, it definitely the regulation helps to build the trustful relationship between the issuer and the investor in this kind of assets.
So from the United States standpoint, much has been made about the need for regulatory clarity on the status of tokens in the crypto space. As far as tokenized securities is concerned, the regulatory impact in the U.S. seems to me to be much more indirect in the sense that while the tokens that are securities are themselves clear, it's the lack of infrastructure to be able to support the development of a market around trading in these instruments. There's lack of infrastructure also among the back offices of many of the investment firms in order to be able to support these instruments sitting within client portfolios. And so what we've done as an organization is starting with infrastructure and building out a custody solution was the first part of how we are going to see infrastructure building out into the marketplace. And with more regulatory clarity, we would expect to see more regulated financial institutions similarly wanting to be able to provide support for these instruments.
Thank you.
I'll speak to Singapore and Hong Kong then to give further coverage. Singapore has benefited, I think, probably more than any other jurisdiction over the last 5 years from having a regulator that's set a very consistent series of rules around digital assets generally. And the entire region has benefited from that because really what businesses most need in this area is a degree of certainty around what those rules are and how they therefore can operate within those guidelines. As an example of that, they therefore are prepared to issue licenses to smaller companies such as ourselves, which is important if you're looking to foster a degree of innovation and competition within the digital asset transition that is starting to take place. Hong Kong has really been much like the US, though it's sort of flip-flop from hostility to a huge potential. I was there last week, and this is the second time I've been there in the last few months. A great deal more willingness now to actually embrace the business side of this, and actually the unique aspects around tokenization and how you can actually impose very effective controls on a fully on-chain market and issuance lends itself extremely well to the domestic Chinese markets too, where capital outflows are typically one of the big concerns they have around this. And on a final note related to Singapore and custody, because you mentioned that interestingly, Cynthia, I would say that that's one of the big things that's also been missing in Singapore are high quality custody solutions for digital assets, and that's really why we ended up going and getting a custody license for exactly that reason.
Yeah, so maybe allow me to say that in my opinion, I believe that in the EU we have the most progressive capital market infrastructure regulation in the world. I think Switzerland kind of led that example by implementing a regulation that allows for trading and settlement to take place on blockchain, also on public blockchain. And then following that example of Switzerland, EU basically put into effect as of March last year what is called the EU DLT pilot regime, right? It is a pilot regime, but after all, it is also enabling us to get exemptions from what is known as CSD regulation. So the degree of disintermediation that becomes realizable marks a special moment in the history of capital markets, in our opinion, right? Because you no longer need a CCP, you eliminate the necessity for clearing. You can realize peer-to-peer atomic matching and settlement on-chain, even though there are some restrictions. And so I think that, in addition to what you just said, I think that a fintech like us can apply for such a license, like I mentioned earlier. Surely is not an easy process, but it allows for innovation on a new system. And I think that we all in this room that have been working for years probably in the industry are now looking at the industry and are asking, specific questions as to when are we going to see liquidity. We need to first of all enable multilateral trading, right? And we need to enable settlement in order for that to happen. And so with that being said, I think that's also one of the reasons why UK has kind of followed that example. Right, if we take a look at the digital securities sandbox, if we take a look at the fact that US capital market regulation, right, in the EU and also in the US has been historically rather closely aligned with each other, that's going to be a key part. I do recognize the amazing work that is happening also in Singapore. I mean, some of our partners from Singapore are here too, definitely making great progress, but it will be about harmonizing that framework for global capital, global tokenized capital markets to actually really get going.
Thank you. Next question is going to be 2 parts, I think. So hopefully you can remember the second part when you've answered the first. But so if you think about your activities to date, in some of the activities you're undertaking, what have been the challenges that regulation has presented to you in bringing those to market or executing against them? And I guess then the second part of that question is, what aspects of regulation help unlock some of the unique aspects of digital assets, if that's something that you can answer, so or you have any thoughts on? So yeah, with you to start with, Max.
Yeah, with pleasure, David. I think that if we take a look at the promises that have been made in the industry over somewhat like 8 years or what, and we take a look at regulation as a means of, enabling us to drive innovation, I always like to say it is the combination of a technology in combination with a blockchain or DLT leveraging capital market infrastructure regulation that is driving this revolution of capital markets. And I think this is something that is really critical to understand, right? We've been talking about like making use of the technology in order to tokenize, issue, distribute. But then again, we've seen a lot of players in the early days trying to make moves with the existing capital market infrastructure regulation, and that does not allow you to leverage this new technology. If you look underneath the hood, if we take a look at what we now have in place, right, and that brings me back to that example, right? We have an exemption from CSDR, right? What does that mean? That means that we can now natively issue security tokens, right, for equity, debt, and fund instruments in the next step, right, without having to go through the traditional players, which we all know who these are, right, for the securities to be recorded directly on the blockchain, right? If you think about what the technology smart contract enabled trading and settlement means, then you no longer need a central counterparty. So these are advantages that can only be realized, benefits that can only be realized if you have a regulatory framework and if you're doing this in accordance or in compliance with regulatory requirements. And let me give you another example, right? And I'll leave it then at that. What has been, security tokenization? What has happened over the last years? And I mean, I was one of those players to offer security tokens already in 2019 through a platform in Liechtenstein. We were creating a representation of a traditional materialized security. And people were wondering, why is that not more efficient? Well, it's not more efficient if I'm wrapping something that already exists in a materialized form just to digitize it. But and I mentioned it earlier, if I can natively tokenize an asset in a dematerialized form, that's when I start realizing efficiency gains and lowering costs, right? That's what will bring this market to an entirely new stage, and that's why we're experiencing now that shift, right? This is a game-changing moment in the industry, and we need authorized market infrastructure for that to happen.
I'll give you start off, I think, with just a couple of things that have been challenging on the regulatory front for our client base. One is that being regulated, you can't face off to retail. So for some of our clients, that's not been desirable because they would prefer to be able to do that, and therefore are looking at other jurisdictional coverage. Another example, though, of where regulation has hindered, I would say, some of the more innovative aspects of digital assets would be automated market making, which for those not familiar is an innovation that came out about 5 or 6 years ago. Ultimately, liquidity pools are injected on either side of a market at creation, and it's algorithmically balanced, enabling instant liquidity, even with a seller without a buyer and vice versa. Now, that is something that we, for example, have had to switch off, even though the functionality is built out on the regulated side of our network for now until the regulator gets comfortable. So I mention it just to illustrate the point that, for me, regulators, there's something of a synergistic shaping of regulations over time with digital assets. Both sides need to be able to meet the needs of one another to some degree. If you think about, for example, concepts like custody, if you are truly realizing a full on-chain model, then the client themselves will effectively self-custody the asset within an on-chain account. So therefore, this idea of a custodial solution does not always apply in quite the conventional way. So that's, I think, just a few things where there's been some challenges. But on the upside, generally too, there is huge potential for this technology to enhance regulation too, because the granularity of information with a golden source of truth of information sitting on a chain, which is utilized throughout that trade life cycle, is fundamental. What that can do is enhance how we handle things like transaction monitoring. There will be, in theory, the potential to use that rich data source for AI transaction monitoring and other kinds of enhancements over the coming years. So I think as an industry, that while there are some challenges right now, it's a net positive for sure.
Thank you. Cynthia.
So when we think about regulation in finance, at the end of the day, finance is still finance, and the ability to leverage technology, or when we moved into electronic trading, for example, there are efficiencies that can be gained in the area of finance through the use of new tools and technologies, and this is where regulation over the decades has evolved to be able to take into account these new instruments, these new concepts in how it is at the end of the day. We're moving capital and we're engaging in transactions, which requires a level of trust, and this is where regulation is able to provide that level of standardization to be able to affect these transactions, but also to facilitate that trust in order for our capital markets to continue to work. And so a lot of the focus over the last few years has been engagement with policymakers and with regulators to educate them about not just what this technology is, but really rather what it can do and how it actually is going to facilitate more efficient flows of capital. And also, we talk a lot about innovation, but what is more going to resonate with regulators and with policymakers is, what is better and what is better for clients, better for investors through the use of these new devices and technologies.
There was actually a lot said already. Let me. It's good and bad. It's this time I'm gonna be the last one. No, in any case, I need to speak also for the regulators. I've been in banking for many, many years, and as we started building out our business model, and we spoke with regulator from the very first beginning, and they actually helped us a lot in terms of defining and designing not only the system, also the business model. Having said that, if you're going to look at the value chain, which was mentioned earlier by Robert, you have the tokenization piece, you have the distribution, you have the trading, and you have the custody. We have been focusing from the beginning on distribution and the trading, and that's still our business model. And we're quite happy with, on the one hand, the regulator helped us in designing also what we can do and we cannot do. And I think it's even also for regulators a very big thing. Why? Because kind of giving a license to whether it's a fintech or it's a new company, they also cover, or they have some reputational risk. Even if you have a new regime and giving out the license, no NCA is going to do that, very likely, because they also know the reputational risk at the end of the day if this whole show screws up. Yeah, that's more or less kind of a thing what will happen with us, because we also have been talking to the regulator for 4 years. After 2 years, we got the first license, and after 3 years, the second one, and constantly taking care of the license. Certainly, the license comes with regulatory costs. However, I do believe that, especially in this field, and I've seen MiCA and why MiCA came actually, that at the end of the day, the trust in the system, in the ecosystem, is also something which will generate a lot of mass market and institutional adoption.
Thank you. So we're approaching time. I've got time for one more question. There's long been a view, well, certainly as long as I've been in asset management, that if we could achieve sort of a harmonized global regulatory regime, the efficiencies are kind of self-evident. And I'm just wondering on the panelists' views on, do we think that this whole sort of digital asset world is a driver of that? And do we think we can, as regulation moves forward, that we can approach a sort of harmonized global regulatory regime? Or do you think there's still, and I think there's still regulatory arbitrage out there, it seems, in the world, and I think it's, from a state standpoint, I think there's still a view that that's a sort of competitive advantage thing. So, how do you see those two things balancing out, or do you think it's just going to be, jurisdiction by jurisdiction? So, David, I'll start with you.
Yeah, sure. I think it's highly unlikely that we're going to see a harmonization of regulations, unfortunately, but there is a variety of factors underlying that. You think about the general differing political ideologies across the world, for example, alone, that tends to lend itself, therefore, to different needs around control. So a simple example would be, look at India and the way crypto is completely banned there, as one example. So, however, I do think the technology lends itself extremely well to being able to handle regulatory requirements and changes in those requirements very, very efficiently and dynamically. So I'll give you one very simple example of that, which is by having the entire trade life cycle on chain for issuance and secondary of all the digital assets our clients are issuing, we've built a full on-chain rules engine that enforces compliance at the asset class and the jurisdictional level. So to a high degree versus the conventional system we're all used to, compliance is something of a semi-automated function. There's still obviously assets and facets that sit with outside of that, but I do think therefore it will facilitate that side of things, but unfortunately there will not, that problem of jurisdictions won't go away.
I have a bit of a different take on that, and I get back to what I already mentioned briefly earlier, and that is, besides the fact that I don't know anything about India, but if I take a look at what happened in Switzerland, if I take a look at what happened in the EU, what's just happening now with the digital security sandbox, if you take a look at those regulatory frameworks, you'll come to understand very quickly that they're extremely close and very comparable. Right, and I think that's actually very important, right? If you take a look at CSD regulation, right, it doesn't only apply to one, nation, but it's much broader regulatory framework. It's important for the audience, I think, to understand that when I'm saying the EU DLT regime, it's EU harmonized regulation already, right? We had like single nations in the EU, like single EU member states moving forward. Implementing national regulations, right? I'm critical of that. I think some countries have done a fantastic job, right? But what we need in order to see like globally tokenized capital markets flourishing is we need to have some form of harmonization. And I think that, I think that's also probably one of the reasons why, as a now to be ESMA regulated market infrastructure, we're also looking to service clients overseas, right? It's a global offering, right? We are allowed, just like a German stock exchange, like Deutsche Börse, to onboard clients also outside of Germany or the EU, right? And so that, I think, will be the first step. And there's a lot of education to do, obviously. Other parts in the world are taking a bit of a different approach. Regulators will learn, will adopt, will improve. Yeah, but I'm actually rather optimistic that we will see that happening over the next years.
Okay, thanks, Max. A minute and a bit from each of you, if you could, just to finish up.
I'll take a little bit of what David said and a little bit of what Max said. I think that the programmability of tokens is going to automate compliance. And so while harmonization of regulation, I tend to agree with David, is probably unlikely across all countries around the world globally, I do think that the programmability of money or the programmability of these instruments is going to make for harmonization of cross-border transactions.
Perfect, thank you. And Mark, to finish.
I think we have to split this up in two things. The service itself, and we see different jurisdictions, and we see different speed. And on the other hand, you have products, and we see also on the product development, meaning a token, meaning a money market fund in the US, in the UK, in Europe. These need to be somehow harmonized so that we as a secondary trading can actually also list those tokens on the platform and offer to our investors. So it's really about differentiating between the service, different jurisdictions, different speed, different stages, different interpretation. However, what we are looking for certainly in each region to list as much as possible high quality tokens in a way to offer to our clients.
Perfect. So we are literally just in the dying seconds. So I'd like to thank the panelists for their views and kind of representing, you know, the world globally. And thank you all very much.